All right. Hello, everybody. Welcome to the Q&A session with the Payhippo founder. Zach, thank you very much for agreeing to spend some time with us today. I've known Zach for a number of years now. Actually, I think I got introduced to Zach when they got out of YC in 2021, if I remember correctly. So I've known Zach for a couple of years, and I really like what they're doing with Payhippo. But I mean, I think this is probably going to be the third time I'm investing in them. So that shows quite some conviction in what they're doing. But it's Zach's show today. So I'm going to let him do most of the talking. I do, the asking of the questions. So, Zach, I'm just going to give you a few minutes to have some introductory statements, and then we dive into some of the pre-submitted questions. So over to you, Zach.
Yeah, thanks, Chinua. It's great to be able to do this Q&A for the folks who couldn't make our live event. So we have some content put together for folks who have submitted questions. I'm going to just start with an overview of Payhippo. So I'm Zach, co-founder and CEO, and at Payhippo, we're building small business banking for Africa. And we've started in Nigeria, where we've done over 30,000 business loans. And for most of the almost 4 years we've been in existence, our monthly collections rate has been 97%. Since we've had this initial success with our loans, we've recently launched other financial products for these SMEs, including a banking app that allows businesses to send and receive money with other accounts in Nigeria. So I started Payhippo with 2 co-founders, and those are Chioma and Uche. Before Payhippo, I was working in fintech financing in Nigeria and saw there was a gap of having reliable working capital that would be fast and convenient for SMEs. Chioma, who is our COO and co-founder, was working in microfinance and international development, and coming from a family of Nigerian small business owners, had a complimentary view on the market. Similarly, Uche, being Nigerian, and our third co-founder, understood deeply the market, but as our CTO was bringing in technical experience, such as being a former engineer at a fintech lending company in the US. So we started Payhippo, we built our origination system, we did a pre-seed round of $1 million, and the next month got into Y Combinator in summer 2021. Then we raised a $3 million seed round. And now that we're deep in 2023 and we made our capital work for a long time, it's time for us to raise a bridge round so that way we can keep building. And we're not far from break even. Our trajectory says that we're looking to hit this in early 2024. And we know that the market isn't great right now for going out and raising a Series A. But while the market isn't great internally, we are getting a lot ready for when the market is ready for a Series A. That means making sure our book is really healthy, making sure that we're not just launching new products, but they're something that all of our customers really want and would like to use. And I'll get into those other products later on. And yeah, let's get to those questions. So Chinua, I'm just going to pull up and start from the top, if that works for you.
Yeah, let's do it.
Okay, so the first question is purely a fundraising question. So less interesting about the business, but let's get to it. It's about why we lowered our valuation cap. We lowered our valuation cap because we need to raise quickly, and every founder I've talked to who is already raising before we kicked off this bridge round was raising for like 6 to 12 months. And we wanted to avoid that happening. So your round moves slower when your cap is higher, and you waste time, and we don't have time to waste. The market is not a good fit for throwing out the more bold valuations. This is a market to come in with more modest valuations and move fast and actually get back to building. Okay. Next question is the person, I'm going to go to the MFI acquisition question.
Okay.
Okay. Have
And
we
by
received?
MFI, the person means the microfinance bank.
Yeah. So MFI. So thanks for the question. We call it MFB. MFI, same thing. We receive approval in multiple steps. There's a final approval for the transfer of ownership for the bank. We have not received this approval yet. This is something that will come later in the year. It takes time to work with your respective officer at the central bank. We're doing that. It just takes time. Thankfully, we really put our own time into finding the best possible microfinance bank. We set out to acquire one in early 2022, and we didn't make the acquisition until the second half of the year because we spent time just going through options, seeing that a lot of the banks weren't up to the quality we wanted. And then when we found one that we did like, doing really thorough DD, right? So whether it's our acquisition or the central bank approval, we knew from the beginning this would be a time-intensive process. And in the meantime, we haven't let that slow us down. We still have our banking app that we've launched, and we've used a banking partner in Nigeria to do this.
Yes, I think just to circle back a little bit on that question. So in the light of, the different things that have been happening recently, Silicon Valley Bank, many of the regional banks, I think someone had asked me a question sometime back, doesn't this bank acquisition, give you some exposure to some of the turbulence that some of the banks are experiencing? So if you could, also help address that, I think that would be nice.
Yeah, I guess the word bank is a scary word right now, but yeah, our acquisition of a microfinance bank is separated from not just any material risks of banking in the global space, but also even just the psychology of, could there be a run on the bank?
Yeah.
And those kind of risks. So like the self-fulfilling psychological risks for banks. Yeah, that our microfinance bank is in Nigeria, where the central bank has a long history of regulating MFBs. Our depositors are small SMEs, and our treasury management, it will be a split of using the funds to help us fund our loan book, and then also investing in low risk asset classes to counterbalance the financing you're doing in your loan book. When you look at Silicon Valley Bank and their use of deposits, this higher risk strategy is the opposite of the strategy that we'll be using for our use of capital. Our funds, again, it'll be split between using in our own loan book and then low risk assets. But the use in our own loan book is going to short-term working capital facilities. Our loans that we'll be financing with the deposits are 1 to 3 month facilities. This is inherently short-term and the exact opposite of what we saw with Silicon Valley Bank. But frankly, like this is like, it's so disconnected that there's like, we're talking about Nigeria's banking system and then a specific banking license within this that it's just like two different worlds, but the word bank is still there.
Yes.
Okay.
Yeah. Yes, I think it's just one of those things where, the number of startups that, Silicon Bank affected was just, very large. And then you're a startup acquiring a bank.
Yeah. I mean, fair, like from a service level, but I'd say like when you actually look at like the way the deposits are structured and the regulatory systems, there's just no overlap. Yeah. Cool. Thanks, Chinua. So the second question that this person had was, they said there are details of loan products referred to in the deal memo, citing that we have put out new financing structures for the SMEs. to adapt to market conditions. And the person's wondering, hey, is this tenor? Is this interest? What do you mean? So yeah, we historically have done mainly 1 month loans, and this year we've pushed from 1 month to 1 month, 2 months, 3 months to extend the tenor of working capital facilities. This is a reducing balance loan. So by the time you're in the second month, the principal outstanding has reduced. That helps you manage risk while also allowing you to have a longer tenor for customers. This is purely in response to talking to customers and seeing that customers were just having a tough time with 30 days, right? And we said, look, let's make this loan work better for their business. And we think that's the best bet for long-term collections, or long-term collections rate. In terms of interest rate, we actually have raised the interest rate. Our own cost of capital has increased. And we think that it's not going to decrease this year, to be frank with you. And of course, when we get our central bank approval and we can blend in our own deposits, we have more control over the actual effective cost of capital. But right now, we see that cost of capital globally is higher. And we are passing the cost on to the end small business. We're doing this step by step. So all new customers coming into our system at a certain size, so our mid-tier and small tier customers, they're all being charged 7% monthly. Before it was 6% monthly. Our higher tier customers, you typically don't push on price with them because they tend to have a little bit more optionality in their financing. And so they could be a bit more price sensitive. So that's how we've adjusted the tenor. One is for making it work better for the customers, and then the other is for our own commercials. And then moving into expansion strategy. Okay, they're talking about timing, markets, go to market. For expansion, I think this person is actually familiar with Sub-Saharan Africa based on their questions. And so, yeah, exactly. So they're talking about expansion, MFIs. So typically in Sub-Saharan Africa, you'll see expansion from country to country. And while we have a team with global capabilities, our focus isn't on collecting as many markets as possible. Our focus is doing a really good job of growing in Nigeria, because this is the largest market in the continent. We also have a majority Nigerian team. So we are well positioned to be strong in Nigeria. Now, Nigeria is not just a country that's homogenous. There are many groups and regions within Nigeria with various risks and various ways to expand. So right now we're focused on the Southwest and Abuja. The Southwest is, in terms of language, fairly homogenous with some localizations throughout, speaking the Yoruba language. So Southwest and then Abuja, because Abuja being north central is quite stable and it's like a more accessible market compared to maybe an extreme example would be the northeast of the country, which is notoriously unsafe.
Yeah, and of course Abuja is also the capital. So
yeah, I mean, exactly. So we actually have licenses to operate, forget our banking licenses that we've discussed. We actually have a lending license that allows us to operate in the broader Southwest and not just Lagos. And we have a lending license that allows us to operate in Abuja. So we've actually, and we have staff in these areas as well. So we've placed staff and regulatory investments in those areas, and we want to dominate those regions. So then the question for expansion is, okay, then do we start to really focus on expanding outside of Abuja into the broader north central Nigeria? Do you start to expand into the southeast, which has Aba market, which is one of the biggest, if not the biggest markets in sub-Saharan Africa? Or do you say, look, now let's diversify beyond Nigeria, right? And let's go explore other markets, right? let's focus on the Southwest and Abuja right now, right? We're seed stage. We're not Series B. Let's do a really good job at the one thing we're doing now, which is small business banking for SMEs in these geographies. Okay. Now, the next question is not a question, but let's definitely discuss it.
Yes.
They said, yeah, they said, I don't believe their stated default percentage is correct. When something seems too good to be true, it's usually not true. Okay. I agree, but it is true. Ours is true. So for the majority of our life cycle as a business, and we've had blips in this, so it's not every single month we've existed, but the majority of our existence, we've had a over 97% collections rate. So 2020, 2021, the average across all the months is above 97. So it's not just 97 collections, 97% collections, it's above, right? And then there have been dips across the way. Absolutely. So we use those dips to calibrate how do you get better at underwriting. Because actually, if you have no defaults, you can't train your model for how to you can't do anything if there are no defaults, but you just have to manage it well. So just to put this person at ease, I'm going to share live data right now of the most recent month, which is April's disbursements, because May's is still being dispersed right now. So let me share my screen.
Yep. I think that should help, address this person's concerns.
Yeah, so this is our business intelligence lead just shared this on the Slack channel. And this is from April disbursements. And so this is an internal presentation. We share these screenshots every day. And so we're monitoring the most recent month. And you'll see in the top left corner, the 0 days past due collections value is 81.8%. So people sometimes are a couple days late to pay loans. That's why if you go to the next one over, 7 days past due, you're at 94.9%. So you're seeing a percentage point increase of 13.1%. 13.1 percentage points. Then it continues to increase, and the collections rate to date is 95.2%. The reason why it's the same as the 30 days past due value is because not all of these loans are even repaid yet or due yet, because we're still in May, right? So by the time it's June, at end of June, we'll have a 30 days past due value that will be higher than what we see here. Our goal, our KPI, is to get 97% collections rate by 30 days past due. And then the tougher target is then we try to push it to 98% by 60 days past due. And then at the same time, you're monitoring loans from previous months and monitoring the loans then from May that are being dispersed, that are already dispersed and due in June, right? So each month you have a new set of loans, right? But this is the most recent, and you now have heard our KPIs and how this will likely develop. But also though, if your feedback to, just going back to the person's question was, I don't believe you. If you don't believe us about the numbers, you're probably just not going to invest. Let's be real. I mean, that's if I didn't believe the startups numbers, I wouldn't invest. So that's okay.
Yeah, I mean, I think from my perspective, the way I look at that question is, this person voiced that concern. Now, others may have, that concern to some extent, right?
Yeah.
I just see this as a good avenue to try to, address. Yeah. So.
Yeah. I'm kind of assuming like this guy's not going to invest, but it's a good question for us to answer for everyone else.
Yes.
Yeah, I think we're aligned there. Yeah.
Just in case there's any other person who has, So yeah.
Yeah, exactly. Cool. So that's all the questions, Jinhua. So unless there's anything else you want to touch on, I think we're good. Or what do you think?
Well, I mean, I think, yeah. So I think those are all the questions we have for now. If you have any more questions, please feel free to send them to me. I would forward them to Zach. The deal is still open. If you're interested, please take a look. Act quickly because we're looking to close this soon. Thank you very much for your time. And yeah, let's make it happen. Thank you very much for your time too, Zach.
Of course. Thanks,
Yeah.
Jinhua. And thank you so much, everyone, for your interest in Payhippo. We appreciate all the support for the company. All right. Thank you.
Thank you, guys. You can stop the recording now.
Okay.